So Datamatics, that is the stock on our radar today. Company reported its Q2 earnings last week, that is on Friday. The net profit came below the estimates, down quarter-on-quarter basis, while revenue and EBITDA saw a growth quarter-on-quarter. Rahul Kanodia, the Vice Chairman and CEO of the company, is joining us now to discuss the earnings fine print and a lot more. Mr. Kanodia, good afternoon. Thanks a lot for joining us. I was looking at your margins. It has expanded on a quarter-on-quarter basis to 15% versus 14.6%. What is the outlook for the remainder of the year? You had guided for 15% margins. And what was the Forex impact? How much did Forex improve margins this time?
Yeah, the Forex margins impact was very minimal. To the extent that we earn in dollars and spend in dollars, it really does not impact too much. In terms of margins, we've done 15%. That's what we had planned or predicted. We should be in the same range, marginally better perhaps in the second half of this year. So that's where we are. It's roughly in the same range.
Right. Would you say the same of your revenues as well? Because the first half you've done about 14%, you had a target of 15%. And I ask this primarily because you get a substantial amount of your revenue from US as well as UK. Both these US, UK, Europe, that's about 2/3 of your revenue. All these geographies are facing growth constraints. So, I mean, in light of that, will you continue to have the 15% growth aspiration this year?
Yes, I think so. The reason is that we do have a little bit of cyclicality in our business. Q3, which is Q3, Q4, which is really for us Jan, Feb, March, tends to be a little higher than the other quarters. That's point number one. Point number two is in this quarter, we've signed new deals worth about $29 million, which is about 50% higher than the previous quarter. So the number of deals signed and the value of deals signed is much, much healthier. And the pipeline looks very healthy. So I'm confident that we will certainly achieve those numbers.
Okay. Digital operations is around 42% of your sales, Mr. Kanodia, and revenue was down close to around 3% on a Q-on-Q basis. And your EBIT margins came off as well to around 22.7% versus a little over 23% last quarter. What were the headwinds that you might have faced there?
No, some of it has got to do with the cyclicality in the business that I just referred to. So in Q3, Q4, that should improve. Also, the reason the margins come down is that we ramp up headcount and get into the preparation mode for the business that's going to come in the next quarter. So you take a little bit of a hit on margin because you've sort of built up the headcount, and then that revenue comes in Q3 and Q4.
What are we expecting in terms of margins within this particular segment, considering that you are ramping up your headcount? Would there be any incremental pressure in, say, the next quarter, next 2 quarters?
No, I don't expect any pressure. In fact, the margin should improve a little bit. It was at 22.7%. It should go up to 23.5%, certainly. And the digital experiences also remains healthy. So I don't expect any downward pressure.
So that is about digital operations, digital technologies. That is a pain point in terms of negative margins for you. Yes, that loss has come down, but still there was a loss this time around, and it is 43% of your revenues as well. Can you tell us what is the outlook here? And once it does come into the black, will it continue to show that performance?
Yes, absolutely. So we should be in the black within this financial year. So I'm not nervous about it. Of course, it's not very healthy, but we are taking all the efforts to improve it. The major reason has been really the salary increase that we've seen across the industry, which has impacted it the most. However, we've been able to cut costs and improve it. So I think we should be in a good shape. Next year, we'll certainly improve further because as I said, we signed some very good deals, and those will start resulting in a positive effect.
So what margins would this particular segment report? What margins would it be next year that you're saying further improvement?
This is a little early to talk about next year, but in the past, we've gone in the range of about 12 to 15%. Given that we were negative 4%, I think we should be certainly in the mid-single digits next year for sure, if not even higher.
That's interesting because, you know, if you are in mid-single digits, then your overall margin should look much better because here's a 43% chunk of your revenue, which is reporting negative margins. Despite that, you're doing around 15%. If this turns into mid-single digits, are we looking at margins upwards of what, 18, 20% or thereabouts in the next financial year?
That is correct. That is correct. But of course, we have to do the planning for the next year. It's a little early right now.
All right.
We have 2 more.
And on that itself, you said that you had to make a lot of hirings, increase salaries, etc. Attrition at 20% is still at higher levels for your company. I mean, the previous quarter was 36%, has come down a little bit. Do you think it is bottomed out and, the worries of attrition are behind the company going forward?
That is correct. So we've taken a lot of steps in training our people, in ramping up new recruits, and also the market has eased off a little bit. And because the market has eased off, we see less pressure on attrition. So I think that should be all right.
Okay. Mr. Kanodia, can you tell us how many new customers you all acquired? Because in the previous quarter, you did say that you all had invested heavily in your true suite of products, and there is some amount of, at least last quarter, there was an incremental number of customers to the tune of around 10 customers that you acquired. But there was some customers which actually exited the business simply because they've adopted a multi-vendor strategy. What were the trends this quarter?
So the customers didn't exit, they just shrunk, but now they've stabilized.
Okay.
This quarter, we've got about 12 new customers. So we continue to run at that rate. We should see a little slowdown in Q3 because of Christmas. Thanksgiving, Christmas holiday, things slow down a little bit. But in Q4, which is Jan, Feb, March, that should improve once again.
Okay. So you'd probably see this average run rate of around 10 to 12 customers added per quarter, except for the aberration that you spoke about next quarter.
Sorry, my mistake. It was 23 new customers.
Oh, 23 new customers.
Yeah.
Okay.
Okay.
And then we see that rate continuing in that range.
Okay, all right. You have 370 crore rupees cash in your books. You had indicated that there will be an acquisition in FY23. You're close to closing that. What is the update here?
We are in dialogue with some companies. That dialogue is still on. It's looking positive, but of course, till it's not closed, it's not closed. So it is looking positive, and I do hope that we can close the transaction.
Yeah. Can you give us a sense of what areas are you looking at? What kind of conversations are you having? I mean, the sizes of those companies, etc. Just wanted to.
I think it'd be premature to talk about the size, but we're looking at digital content is one space, and digital technologies is the other space, more around the area of cloud and Salesforce and things like that.
All right.
These are the new page.
And we'll hear about it in this fiscal itself, perhaps this quarter or maybe the next.
We should.
Okay, take that point. Thanks a lot for joining in, giving us the outlook on the business, maintaining that 15% revenue and margin guidance for this year, but next year should be better.